Well, thanks everybody for joining us at the weekly call. Let's get right into it. It's been an exciting week and we got a few questions to answer. You want to talk about Veterans Day?
Yeah, I came across this trivia today, and I never knew why Veterans Day was on November 11th. But apparently it was the 11th hour of the 11th day of the 11th month of World War One that Germany surrendered, which they came up with November 11th. So there actually is a reason it's the 11th. It's 11th hour, 11th day, 11th month, 1918, when the war ended. For those of you who will celebrate Veterans Day, both my parents served in the Navy. My wife's father served in the Navy. He was actually on D-Day on Omaha Beach. So we have veterans in our family.
Yeah. So we're going to be open that day. The bond market is closed, so there's a few things we can't do, but we can do most things that day. If you have questions for the Thursday call, remember to send them to service@o'harewealth.com, or you can text us at our mainline number. With that, we're going to get right into it. What are your thoughts on the election results? Do you want to start or should I?
Well, let's both answer this today because this is a big question. I think the biggest thought, more emotion, is relief.
Yes.
I mean, that is what's going on, is relief. Many of us expected a drawn out process for days, if not months, like what happened in the end of the last election and the election before that. We expected, if you go back to the first Trump administration, we had the Russian collusion, and then we had the contesting when Biden won. Everybody was braced for basically havoc and uncertainty, and we didn't get it. It basically was over 2 a.m. in the morning, 3 a.m. in the morning. People have moved on. Everyone I talk to, it literally is a sigh of relief, which leads us to the markets because, JJ, I'll let you take it from here, but this is a classic relief rally.
Yeah, nobody wants to be invested when you don't know who the president's going to be. We saw this actually going all the way back to Bush Gore. Those several weeks were not good for the market. Nobody wants to be a part of it. And so having the solution very quickly is very positive. What can you say about what happens as a result of the election? We've said this many times: when you're betting on policy changes, bet on no change. The things that are now probably more likely, do the Trump tax cuts stay in place? Remember, they're called the Trump tax cuts, say, past 2017. Yeah, they probably do, right? I mean, and the Bush tax cuts stayed under Obama. We were kind of expecting them to stick around for the most part, regardless of the administration. The Biden CHIPS Act, well, it's probably going to stick around too. I mean, a lot of these things stick around well after the person's president. And when we buy stocks, we always buy them with a 10-year time horizon. That's at least another administration. So whenever we're looking to buy things, I think I was watching CNBC the night of the election, and one of the commentators said, we're not sure if Kamala is going to win. We're not sure how Trump's going to perform. We are expecting earnings growth to be 9% next year. And I think to some extent, they're taking the right tact. Our expectations for growth, for the GDP growth numbers, have not changed. Our expectations for earnings growth have not changed. There's been no major changes in that regards. There are some things that are probably slightly more likely. Like we talked about, the corporate tax cut, corporate tax rates are probably not going to change with this incoming administration, because that's not a promise that they made or encouraged. Sorry, go ahead.
I was going to add, JJ, and we've been watching the markets. The markets were making new highs before the election was over.
Yeah.
And we've been watching this carefully. Bonds have been doing horrible. We'll talk about that later. But, we've shifted our commentary before the election from a soft landing to a no landing or soft landing. GDP growth was 2.8 last quarter. The other economic data that's come out has been stronger than expected. we might have a situation that's the economy really accelerates. So the market was giving us that hint before this. But when you take away the uncertainty of the election, and when you basically the incoming administration, you're right, JJ, they're the ones who pass these tax cuts, so they're unlikely to change them.
And,
The market feels good about
it. And of course, if you go back just like 3 months ago, when people asked me, when do you expect the next recession? Nobody said, but under which president? That wasn't
right.
a thing. They've been saying that for the last 2 weeks. And I think in probably 3 months from now, no one will ask that question. They'll ask me again, when's the next recession? But it won't be as a result of the incoming administration. That's not how economics works, and we've said that many times. So I think
I think we can finish with that one. Quite frankly, it is a relief. We don't have chaos in the streets. We don't have people worrying about recounting. We don't have lawsuits against the ballot counters and all that stuff. This has turned out relatively calm, which I'm like everybody else. I'm relieved, and I just want to move forward.
Yeah. So we're focused on looking forward. Which, speaking of, what do you think the Federal Reserve is going to do with rates this week? That meeting is actually today. I believe that's just a few hours. We expect them to cut. We expect a 25 basis point cut as a result of the data that they're seeing. Could be more, could be less. Probably the only thing that's changed recently, and this has nothing to do with the election for the most part, is long rates have gone up. And if long rates have gone up, it means that the market is expecting relatively strong economic growth. So the Fed might not have as much room to cut down to that 3% number as they were initially anticipating. And remember, when they first started cutting, people said, all right, great, we're going back to zero. And we were very firm. No, the Fed is at 3% on the neutral rate. That's their target. They might not be able to get to their target. And it would be very reminiscent of what we saw during the 1995, 1996 cycle, when the Fed said, we're going to start cutting rates, and they stopped cutting rates during that. And that was just because we had a soft, no landing scenario. I mean, it's very sort of reminiscent of that period.
Yeah, I lived through that. 94, the Fed raised rates aggressively. We had a bear market in bonds and stocks. And then 95, the economy started picking up. There was no recession. They started lowering rates again, and then they stopped, and the economy took off for several years. We could be in a similar situation right now. But I will tell you this, the Federal Reserve's decision today has nothing to do with the election. It has everything to do with their dual mandate, which is full employment and stable inflation. And so they're looking at that hasn't changed. Inflation has continued to come down. Unemployment is still at 4.1%. So there is no reason for them not to continue their cuts.
Yeah, inflation running at whatever it is right now, 2.5% of the 3-month rolling, and unemployment at 4.1. They're essentially achieving their dual mandate. So that they've got room to continue to cut, but if the economy keeps being this strong, they might not be able to keep cutting. They might have to keep rates a little bit higher for a little bit longer. We might only get to 3.5 on the Fed funds rate instead of 3 as they initially projected. Should we go to the last question?
Sure.
My bond portfolio seems to be performing poorly. What's going on? Yeah, I don't know if anybody remembers the quarterly chart party. I had a chart up here, and I was talking about the 10-year at 3.8, and the chart was a week old, and I had to mention that it was outdated. The 10-year's gone from 3.8 to whatever it is today, 4.43, almost 4.4.
It was 4.4 something yesterday. So it gave off a little bit, but it's been quite the bear market in bonds.
And to put that in perspective, that equates to roughly a 20% decline in 10-year Treasury notes in just the past 6 or so weeks.
Yeah. So if you bought those bonds 2 months ago, you've lost 20%.
We've been very reluctant to go long duration, and we were very obstinate with that. I know when the Fed first started lowering rates, that was several of the questions we got, which is, are you guys going to go long duration now and make real money with bonds as rates go down? And we said no. We think most of the curve is done moving, and we're not going to leap out there. We want to keep our bond portfolio relatively short, and our our aggregate bond portfolio right now is probably half of what most people's is, because we were worried about exactly the scenario that rates wouldn't continue to decline in the long end of the curve. Because remember, the Fed does not control the long end of the curve. They control, or excuse me, they control the short end. The market controls the long end, and that's determined by growth projections. So we were concerned about that. We kept very, very short. So we didn't, our net portfolios probably aren't nearly in the same situation people are if they bought 10-year treasuries or 20 or 30-year treasuries. Those are even worse off. But it does mean that, mortgage rates are probably going to be a little bit higher than they were just a month ago, because most mortgage rates are based off the 10-year treasury. There are still some things that are concerning out there. But yeah, from a portfolio standpoint, we don't talk about it because the stock market is hitting new all-time highs, but the bond portfolio is going through a heck of a mess right now.
Yeah, it's interesting because you're right. The long bond portfolio, 10 years or longer, is in a bear market right now, and a nasty bear market. We've always, and this is a strategy and philosophy that we have, we always tend to stay shorter duration. And duration is the fancy finance word for maturity. It means the bonds we own, most of them are going to mature within the next 1 to 4 years, 1 to 5 years. We don't own any 10-year bonds, and we don't own any 10-year treasury bonds. And so we don't have as much what we call duration or maturity risk. And it's paid off well for us. Our bond portfolio we looked yesterday is yielding just about 6% with that short duration. So I'm not sure why I'd buy the 10-year at 4.40 and take more duration risk. We do take a little higher risk. We do buy bank loans. We do buy high yield bonds. And we get paid for that. But we've been doing the same thing for years. And in 22, when the bond market fell 13, 14%, we fell much less on average because of that shorter duration or maturity. This is from us is a long-term philosophy. We'll always tend to stay on the shorter side. We think it's just safer, and you're taking less duration risk is good for our clients.
And part of that philosophical piece is why do you buy bonds? You buy them for safety, and you buy them in conjunction with when you expect to use the money. So who buys these bonds? Insurance companies buy these bonds, right? Pension funds buy these bonds. They need to know what their next 10-year return is. For most clients, the bond portfolio is really that 3 to 5 year space. That's when they're going to need the money. So we should have bonds that are lined up from a 3 to 5%, because the only reason I should buy a 30-year bond is if I have a 30-year balloon payment. And most people don't have a balloon payment in 30 years, but that would be a great reason to buy a 30-year bond. But for most clients and most individuals, that just doesn't exist. So then you're taking a long-term bet on growth rates and inflation over 30 years, which, that's hard.
I'll leave you with this. It's kind of funny because we pay attention to the bond market, but the financial channels and the newspapers pay attention to the stock market. If the stock market was down 20% in the last 8 weeks, everybody would know it.
Yeah, be all anybody could talk about.
Should move on to, I think we have a new book this month, don't we?
We do. Annie Duke's Thinking in Bets. This part of what we do on a daily basis. She's an ex-poker player, and really what the book is about is it's reminding you that you want to do your research. You want to get the best possible chance you can to win. And sometimes that just doesn't work out. And, with whatever you're doing, and poker is probably one of the best examples. I think everybody's played a little bit of poker at some point in their life. And they've gotten what they call a bad beat, where the opponent only had 1 or 2 cards that could have saved him, and somehow they got it. You made all the right bets. You played the hand correctly, but sometimes the cards just don't break your way. There is a thing called weather out there. There is luck. There is unknowns. You can make all the right decisions and still end up not having to come out. But that doesn't mean you should change your philosophy and go in a different direction, right? You shouldn't start playing bad hands or taking wild bets or going after a wild goose chase to try to fix a problem when you know what the actual solution is, even if the solution maybe had short-term bad results. Right. I mean, yeah. If you're rolling,
Yeah,
if you're rolling dice and you say, well, I'll bet on 7, which is the most common, and it comes up snake eyes 4 times in a row, you don't start betting on snake eyes all the time. It's not,
good point.
you know, the average is closer to 7.
Yeah, it was a good read. It was an easy read, and it just reminds you to keep in mind that there's no sure things. And just because you bought a certain stock in a certain industry and it worked once doesn't mean it works again. So you really should be considering the risk every time you're making one of these choices.
Well, thanks for joining us today. With that, we look forward to future questions. I think we used up our 15 minutes. And thanks everybody for joining us. And then hopefully we'll talk to everybody next week.
Yeah, and have a good Veterans Day.
Yes, excellent.
Thank a veteran.